Good afternoon, ladies and gentlemen. I am Pelshia, moderator for the conference call. Welcome to ONGC's Q3 FY24 earnings conference call. We have with us today Mr. Manish Patil, Director HR, holding additional charge of Director Finance, and his team who will interact with investors and analysts to discuss Q3 earnings. As a reminder, all participants will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touch-tone telephone. Please note this conference is recorded. I would now like to hand over the floor to Mr. Manish Patil. Thank you, and over to you, sir.
Good afternoon, ladies and gentlemen. Just to introduce, I am Manish Patil, Director HR, holding additional charge of Director Finance, ONGC. I welcome you all in this ONGC earnings call for Q3 and 9 months FY24. Thank you all for joining us on the call. I am joined here by my colleagues from ONGC, Mr. K.C. Ramesh, Chief Corporate Finance and Accounts, who has been designated as CFO, Mr. Pawan Agrawal, Chief Corporate Planning, Mr. F.K. Dwivedi, Chief BD and JV, Mr. Devendra Kumar, Chief Commercial, Mr. B.R. Subudhi, Head Corporate Accounts, and Mr. Prakash Joshi, Head Corporate Budget and Investor Relations. Mr. Vinod Hallan, Head Finance, and Mr. Mukul Bhatnagar, Head Planning and Strategy, have joined me from ONGC Videsh Limited. ONGC has compiled its financial results for the quarter and 9 months ended 31st December 2023, which have been reviewed by the statutory auditors. The financial results have already been released on 10th February 2024 through a press note and sent to stock exchanges. This has also been sent to the analysts who are there on our mailing list. Here is a brief synopsis of the results. The company has earned a net profit, that is profit after tax, of rupees 9536 crores during the third quarter of FY24 as against rupees 11045 crore during the third quarter of FY23, a decrease of rupees 1509 crore, that is 13.7%. The profit after tax for 9 months FY24 has decreased by rupees 9310 crore, 23.8%, that is from profit after tax of rupees 39077 crore in 9 months FY23 to rupees 29767 crore in 9 months FY24. The decrease in net profit during Q3 FY24 and 9th month FY24 is on the account of lower sales revenue, mainly due to lower crude oil, natural gas and VAP price realizations and provisions of GST on royalty. The sales revenue for Q3 FY24 and 9 months FY24 has decreased by rupees 3721 crore, that is 9.7%, and by rupees 15408 crore, that is 13%, as against the corresponding quarter and 9 months of previous year. The billing, that is net of VAT or CST, for the crude oil during the third quarter of the current fiscal was at $81.59 per barrel, as against $87.13 per barrel in the same period of last year. That is a decrease of $5.54 per barrel. The exchange rate of rupee versus dollar stood at rupees 83.27 vis-a-vis rupees 82.20. Thus, realization for crude in rupee terms stood at rupees 6794 per barrel in Q3 FY24 vis-a-vis rupees 7162 per barrel in Q3 FY23, that is a decrease of rupees 368 per barrel, that is 5.1% in INR terms. Similarly, gross billing for crude during the first 9 months of the current fiscal was at $80.92 per barrel, as against $96.99 per barrel in the same period of last year. That is a decrease of $16.07 per barrel. The exchange rate of rupee versus dollar stood at rupees 82.71 vis-a-vis rupees 79.77. Thus, realization for crude in rupee terms stood at rupees 6693 per barrel in 9 months FY24 vis-a-vis rupees 7737 per barrel in 9 months FY23, which amounted to a decrease of rupees 1044 per barrel, that is 13.5% in INR terms. The expenditure on statutory levies, that is royalty, cess and excise duty, have decreased during Q3 FY24 by rupees 1625 crore, 14.6%, and in 9 months FY24 by rupees 8629 crore, that is 23.7% in comparison with similar period of previous years. This decrease in statutory levy is attributable mainly to decrease in sale price of crude oil and levy of special additional excise duty SAED by Government of India on production of petroleum crude at a rate revised on every fortnight based on international crude price. This SAED on crude have been levied with effect from 1st of July 2023, which amounted to rupees 9435 crore in 9 months FY23 and rupees 6710 crore during 9 months FY24. There is an increase of rupees 721 crore in the exploration cost written off in Q3 FY24, that is from rupees 1607 crore in Q3 FY23 to rupees 2328 crore in Q3 FY24. This increase is mainly due to increase in unsuccessful wells charged off mainly at Western Offshore and Mahanadi Basin. The operating expenditure has increased by rupees 105 crore, that is 1.7%, from 6275 crore in Q3 FY23 to rupees 6380 crore in Q3 FY24. Similarly, the operating expenditure in 9 months FY24 has also increased by rupees 1524 crore, that is 9%, from rupees 16935 crore in 9 months FY23 to rupees 18459 crore in 9 months FY24. The increase is mainly on account of the increase in contractual payment by rupees 101 crore mainly on KG 98/2, other expenses rupees 356 crore, transport expenses rupees 61 crore, power and fuel by rupees 79 crore mainly at Western Offshore assets, repairs and maintenance rupees 323 crore, and water injection by rupees 227 crore mainly at Western Offshore due to increase in activities. DD&I cost for Q3 FY24 and 9 month FY24 stood at rupees 5078 crore and rupees 14785 crore respectively, as against rupees 4855 crore and rupees 11959 crore respectively during the corresponding period of previous year. The depreciation for 9 month FY24 has increased mainly and Eastern Offshore 98/2 by rupees 966 crore due to depreciation on ROU asset of FPSO. Similarly, the impairment for 9 months FY24 has increased due to reversal of impairment amounting to rupees 2129 crore last year on certain discovered small fields of the company falling under 10 contract areas which were awarded by DGH to the winning bidders. The company at a consolidated level has earned a net profit, that is profit after tax, of rupees 10748 crore during the third quarter of FY24 as against rupees 11665 crore during third quarter of FY23, that is a decrease of rupees 917 crore, 7.9%. Similarly, the company at a consolidated level has earned a net profit, that is profit after tax, of rupees 44685 crore during 9 months FY24 as against rupees 27076 crore during 9 months FY23. That is an increase of rupees 17609 crore, 65%. This increase in profit can be mainly attributed to our subsidiary HPCL, MRPL and OVL. Board has approved second interim dividend of 80%, that is rupees 4 on each equity share of rupees 5. The total payout on this account will be rupees 5032 crore. This is in addition to a payout of rupees 7234 crore, first interim dividend of rupees 5.75 per share, 115% declared earlier in November 2023. Lastly, before I finish, I would like to add that to counter the decline in production from some of the matured and marginal fields, ONGC is taking proactive steps by implementing well interventions and advancing new well drilling activities. The decline in production from matured fields will be compensated in upcoming quarters with commencement of additional production from upcoming projects which are under various stages of development. Crude oil production as you are aware, has already commenced from KG 98/2. Hopefully, we would be better placed with oil in the last quarter of this FY and gas in the coming financial year of 24-25. We also wish to inform that the price for the gas in the coming financial year would be better improved as compared to this year. Well, friends, with this, I finish my briefing of the third quarter results for the financial year 2023-24. We'll be very happy to take questions from you. We would request you to restrict your queries on financial results only. Thank you.
Thank you, sir. Ladies and gentlemen, we will now begin the question and answer session. If you have a question, please press star and 1 on your telephone keypad and wait for your turn to ask the question. If you would like to withdraw your request, you may do so by pressing star and 1 again. I repeat, ladies and gentlemen, if you have any question, please press star and 1 on your telephone keypad. First question comes from Varadarajan Shivashankaran from Antique Stock Broking Limited. Please go ahead.
Thanks for the opportunity, sir. So you mentioned about the production issue. If you can elaborate a little more on that. So our understanding is that, KG Basin obviously is contributing to the oil increase this time around and will contribute to the gas increase next year. But subsequently, effectively, in terms of compensating for the declining production in the other fields, what would be the situation in, say, FY26 or 7 with regard to the developments in the existing, new reserves which you have found over the last few years, as well as any IOR activity? So what is the kind of indication we can get in terms of a sustainable production both on oil and gas?
Vartas, just 1 second.
Okay, namaskar. With respect to your question about the future growth projections, with the start of the first oil from the KG 98/2 project and the upcoming programs, we envisage that we will be ending this year on similar numbers as we were having in the FY23 or slightly better than that. But however, moving forward, we hope to have an increase by around 15% in the next 3 years by 26-27. And we have got a number of projects which are all lined up. We have got something around 22 development / the infrastructure project with a capex outlay of around 60,000 crores. And those projects will also contribute to our growth trajectory. And secondly, as you know that we have got the old mature field where we have got around 6 to 7% decline. So we are making the consistent efforts to maintain those productions and to reverse this declining trend. We have given a focus on few of the activities on the water injection prioritization, on the equipment availability, on the operational efficiency improvement, on the resource augmentation with respect to the drilling rigs, the vessels or the helicopters, and the induction of the state-of-art technology in the drilling rigs. So these are the few measures which we are taking up on an aggressive basis to arrest the decline from the old mature fields. And secondly, we have got a number of development projects which are lined up, which will be contributing towards our growth trajectory.
Thank you, sir. Thank you. My second question was on the 20% premium to the incremental gas production which is proposed. I understand it is still not been cleared and notified, but as and when it comes, what is the proportion of our APM production which will be eligible for this kind of a premium pricing currently, and if it can give some visibility as to how it can potentially increase over the next 2 to 3 years, I guess.
Currently, as per the definitions of the gas premium pricing, any well intervention or the new well which is coming up in the existing nomination field will be eligible for this 20% gas premium pricing. Currently, during this year FY23-24, it is contributing something around 3 to 4% of our current gas production, and moving forward in the next 3 years, we hope that the contribution from this new the gas and towards the premium pricing will be in the tune of around 20%.
Thanks a lot.
Thank you. Next question comes from Amit Rustagi from UBS Securities. Please go ahead.
Yeah, thank you. Sir, thanks for posting a great set of numbers. My question relates to KG Basin field. Like, what is the capex we have incurred till date? What is our remaining capex in this field? And how are we going to see the cost of production, both for oil and gas? And will it increase our DD&A expense as well? So if you can help us understanding these aspects.
Yeah. As you are aware, the total capex that we had planned for KG 98/2 was around 5 billion, and the substantial part of which we have already spent. So around 28,000 is the amount, the progress till date that we have incurred on that. There are some small cost escalations happening because of some change orders and things like that, but they are not very substantial. So in terms of cost, we are comfortably placed as far as KG 98/2 is concerned. Coming to your second question was with respect to
The production cost.
Cost of production and
cost of production. See, the cost of production, as you know, is basically the offshore is generally the cost is more, but it is a function of the production quantity that we get. So the per unit cost is normally like, depending totally on the quantum of production. So considering that the current production that we are expecting from there, it is expected that it will be on a slightly higher side than the western offshore, but it will be the range which is expected for the offshore.
So can you give us a total cost, like what is the FPSO cost per day, and so that we know like what is the production and we can calculate on ourselves?
Yeah, FPSO, the day rate is currently including GST 7,18,000. That is the per day cost for FPSO. Apart from that, like as you know, we have the normal other operating costs like material consumption would be there. Then there could be some work or operations. The normal typical E&P industry cost which we incur for producing. So those would be there. There could be some water injection cost as well. So the overall cost picture will be clear once we start producing fully. The gas production is now, we are expecting, as earlier Mr. Pan was saying, that in the first half of next year, somewhere maybe June, July. So yeah. So, based on that, the cost will crystallize. But yes, the substantial part of the cost there for oil is the FPSO. The other facilities are yet to be installed over there. So once it is installed, we'll have a clearer picture on that.
So I think the cost will be
DD&A, yeah.
in 25-26 when we will be having the full scale production for the fleet.
25-26 years. Yeah. How you're going to appropriate the $5 billion cost over how many years, basically?
Yeah, normally, like, the cost, the capex cost that we allocate is through by way of, depletion, as well as the cost pertaining to FPSO is concerned. It's like, Ind AS 116 on the base of the lease. So we have already started booking the depreciation and depreciation part through the lease part. So which you might have seen that there is some substantial increase in the depreciation in the current quarter as well due to the lease booking which you have already done for the FPSO. So some part of the hit we have already started taking on that. So that would be a regular expenditure by way of booking through lease. And the facilities that we are going to install, that would be on the base of the reserve there and reserve to production ratio. Normally on an average, around 10% is the reserve to production ratio. So 10% annual the expenditure that we incur on the capex is by way of depletion.
Okay, sir, got it. And sir, I have a question relating to the offshore rigs, basically we have around 40 offshore rigs. So could you give us, I think we were able to achieve a major cost saving program over 2021 when the rig rates were actually down. But now we have started to see rig rates moving up. So how much of it is already being renegotiated and how much of it need to be renegotiated over the next 1 year? If you can give us some color on that.
See, relatively, we have a longer, contract periods normally in the range of 3 years. So, the total rigs that you're talking about, 40, is distributed over some of the, costs which we had, the rates which we are currently having. They are continuing with the past contracts, and some of them are new. So it's a mix of new and old, as of now, the rates which are going on. So, as far as the rig cost is concerned, whatever cost that is incurring, it's increasing on the base of the current contract rates. It's compensated by the contracts which we had already entered in the previous year. We don't have any system of renegotiating the rates as such. Normally, what we do is we enter into a new contract once the earlier contract expires. But yes, if there are opportunities where we can extend the current contract at a cheaper rate, that also we look into.
But what I'm trying to ask is that if there is any increase in cost because of renegotiation in the last 1 year, because when you entered into contracts in 2021, they were substantially at a lower rate, but now I think the markets have moved up quite a bit on the rig side. So what are the increase in rate we are experiencing right now in renegotiating the contracts?
No, we don't renegotiate, but if you are asking that with respect to the new current contract that we are entering, yes, what is the rate, then that is in the range of around 10%, right?
18-19. Just one sec.
Yeah, currently the rates that we are getting on the new, jackup rigs that we are hiring is around, in the range of $70,000 to $90,000 dollars per day. That is the operating rate that we are getting. Yes, you know that during COVID period, it was around 45 to 50,000 around that. So that is the increase that is coming currently in the market. But we are expecting that based on the projections, the rates could cool down in future.
Okay, great, sir. So thanks for answering my questions and best of luck. Thank you, sir.
Thank you. I request the participants to restrict with 2 questions in the initial round and join back the queue for more questions. Next question comes from Probal Sen from ICICI Securities. Please go ahead.
Thank you very much for the opportunity, sir. I had one question with respect to the exploratory well write-offs. The director sir mentioned that this was due to higher unsuccessful well write-offs in Mahanadi and the Western Offshore. I just wanted to understand, does this change our assessment of reserves addition? Because I think Mahanadi development and the Western Offshore are 2 of the major development projects that we have ongoing. So do these unsuccessful wells impact our assessment of reserve addition from these projects?
Not exactly. Actually, unsuccessful wells are basically, though we have discovered in the Western Offshore much in the past, we keep, continuing to go for further exploration there. So basically, as per the policy, wells which we take up only for the purpose of investigation, like expendable wells that we charge off irrespective of whether we have some find or not. You must have seen that recently we have had some finds in Mahanadi. So the development of the field further does not have any relation as far as the dry wells that we are booking. Dry well booking is basically based on the accounting policy that we have with respect to whether a particular well has been declared dry or whether that we are not going to use it anymore like an expendable well. So that's the basis on which we write off. It has nothing to do with the reserve that we accrete from the field. Reserves are totally based on the findings and further investigation by the exploration group.
So our assessment of whatever growth we assume or we have built into our MOUs or projections, they remain unchanged as of now from these 2 projects, right?
Yes.
Okay. So the second question is with respect to, the projections. You did mention that you are aiming still to end the year at roughly flat oil production, and which would be somewhere around 16.9 million tons, if I am not mistaken, and that was the run rate in FY23. I wanted to understand for FY25, what kind of exit rate should we actually be building in realistically, assuming that oil production would be ramping up steadily from KG, and some element of around 6 months of gas production should also be there. So, against the 16.9 million tons of oil and about, I think, 15.3 odd BCM that we should do in gas this year, what is the exit rate we should build in for FY25? If you can give any sense on that.
In the FY24, as you may be knowing that earlier years,
25.
As you know that in the earlier years we were facing a decline rates to the tune of around 4 to 5%. However, last year we were able to manage it with around 0.5% decline. This year we will be above that. We will be maintaining the numbers of the last year or slightly above that.
Right.
And now moving forward with this 98/2, because the FY24-25 we will be getting the partial production. So we will be getting the peak production for the partial year. So in FY24, FY25 we hope to increase our current production by around 5 to 6%. And we will be getting the full plateau production from the 98/2 in FY26.
So the 15% increment that we are talking about over the next 3 years essentially can be divided up into 5 to 6% increase pretty much every year that we expect over the next 3 years, correct?
That's right. In FY27 we are expecting a slightly higher increase, because by that time we will be getting another project of Daman upside. From where also we expect around 4 million cubic meter gas per day, equivalent to around 1.5 BCM. So it will be 98/2 plus Daman upside will be the two major projects which will be contributing towards around 14-15% production increase by FY27.
I apologize, sir. I did not get the name of the other asset other than KG 98/2. What was the other asset?
That is the Daman upside project.
That's on the western offshore.
Western offshore.
Daman upside.
Yeah. Daman.
Okay. Sir, last question, if I may squeeze in. What is the kind of plateau period once the asset hits peak production of 10 MMSCMD and let's say somewhere around 40,000 barrels of oil per day from KG? What is the kind of plateau period that we are expecting for this production to sustain?
We anticipate a plateau of around 2 years.
Plateau of 2 years and then a steady decline thereafter, assuming no other well interventions happen.
The other project, other infill wells will be coming up. The cluster 1 will be adding up in FY28. So that will make up for the any decline.
Understood. Thank you very much, sir, for the detailed answer. I appreciate that. I'll come back if I have more questions. Thanks.
Thank you. Next question comes from Mayank Maheshwari from Morgan Stanley. Please go ahead.
Thank you for the call, sir. 2 questions from my end. First was more related to capital allocation. Can you just talk a bit about how are you thinking on a net cash standalone balance sheet? And I suppose you are seeing some improvement in terms of receivables on OVL as well as subsidiaries doing reasonably okay now. Anything on the dividend policy then you can talk about in terms of how you are thinking about DPS and growth in DPS with the volume growth that you are expecting? And if you can also talk on the same page on OVL and the collections on OVL in terms of issues you had in the past, how are that kind of panning out in Russia, Venezuela, or Sudan? Thank you.
So I think first OVL would like to answer your question. After that, the first question will be answered.
Regarding OVL, you have asked actually the position regarding Russia and Venezuela assets, what is the current situation. So on the Russia, we still have, due to the Singapore being an unfriendly jurisdiction, our dividends are still in hold up in Russia. However, we are at advanced stage of trying to pursue with the Rosneft to accept the abandonment obligation upon OVL for getting back our 20% shares to be squared up in rubles. So our application with the Russian authorities is expected to be heard very soon, and we hope to close this transaction of meeting the abandonment obligation. Regarding Venezuela, you are aware that the sanctions have been lifted and they will remain open until say 18th of April 24. And we have received a kind of proposals from the PDVSA, which are under negotiations. And we are also exploring the banking route and trying to open up the bank accounts for easing up the funds flow, remittance inward and outward remittance from the country. So, given that the situation continues to ease up, we hope that we will be able to secure our, we are seeking barrels from Venezuela for the dividend, outstanding dividends, and we hope to actually secure those rights to receive barrels. Regarding other projects also, the outlook is positive.
Yeah, just one.
So we are other projects also, the outlook is positive, and we hope to gain positive positions in those projects also.
Mayank, now I think first question will be answered by our CFO, sir.
Yeah,
Sure.
Your question was with respect to the dividend and the capital allocation. You know that we have been a consistent dividend paying company. Over the last few years, we have been paying around 40%. So currently also, if you might have seen that we have already paid 9.75, it is almost 41% in this 9-month period. Maybe in the last couple of years, probably it was slightly lesser. But yes, we have the plan to have that numbers continuing and being a good dividend paying company. So that will continue. As far as the capital allocation is concerned, given the current price and that we have a comfortable price even after considering SAD, and as earlier we were saying that on the additional gas we are going to get a substantial higher price of almost 9 to 10 per MMBTU. So with this, we expect that we will have a good cash flow position going forward as well. So whatever that we have, the normal capex that we have is around 30,000 crores annually for our normal E&P operation. So apart from that, the dividend that we are paying, so over and above that, we have some surplus cash available, which we going forward plan to slowly move out to venture into other areas as well, apart from the conventional E&P. So you might have already seen the announcement with respect to our investment in Opal, green energy initiatives that we are taking. So with all those things, we would be slowly moving ahead, utilizing our future cash flows in those areas as well for the capex.
So can you just give us a guidance on the capex for the next couple of years for fiscal 25 and maybe beyond, of how much you are thinking about allocating each year apart? Is that the same 30,000 crores that we can assume now going forward?
So Mayank, what you can expect, it could rise in the current year, say, in the range of 33,000, and next year it would be somewhere in the range of 33 to 35,000 crores. This I'm talking of the standalone capex.
Standalone, that's only for the...
Yeah, standalone capex of ONGC.
Other than the integration project, standalone capex.
Okay. And so can you just give it a bit of a holistic picture across the ONGC group of what kind of capex and the shift in capital allocation between upstream, downstream, midstream and renewables that you will have? Roughly a big picture sense.
It would be difficult for us to, talk about the capex plan for the subsidiaries currently at this juncture. But as we said that as far as ONGC is concerned, the conventional investment of around 30,000, normally 30,000, so 32, 33 is the next 2 years, as Prakash was saying now, as far as ONGC is concerned. But the allocation for other investment, there are the OVL, we are planning to,
OVL, before this, the FM situation in Mozambique, we were having a budget of 8,100 crores. After that, the 2 years budget was scaled down, and current year BE is something around 3,300 crores. but with the resumption, likely restart in the next year, we will have a budget of around 1 billion, around going back to say 9,000 crores on the OVL side. And that level of budget will continue for the next 3 to 5 years.
And as far as renewable energy
Got
is concerned, we have already announced that, we would be planning to spend around 1 lakh crores by 2030. So that plan is there, but that's a relatively a longer term plan, so the things, are being worked out in integrity.
Yeah, fair enough, sir. So just the last thing on this point on Mozambique, can you just help us understand the restructuring that you've announced and what are the implications in terms of earnings, taxes, etc. on the recent restructuring that you announced?
Restructuring of the operator organization, right?
That's correct, Mozambique, yeah.
So actually you see that restructuring has got not much to do with the taxation. It has got rather actually, because Mozambique is a big size LNG project with a very high level of capex, which was actually announced at $15.4 to $1 billion in June 2019. And this project development has been secured through project finance. So the project finance was agreed for $16 billion. Now to have that kind of debt on the partners books, holdco model, asset co model has been evolved, under which the assets of the project and the debt will remain in the asset co and will not get transferred to the respective partners books. So that actually is the purpose for which the asset co model has been created. Because right now the project is like Indian Consortium has 30% participation in the project, of which OVL holds 16% and 10% OVRL. So OVRL has assets of 10% and our associate BREML has assets of 6%. These will get transferred to the asset co model company, Moz LNG. And the debt will also remain in that company only.
Got it. Clear. Thank you for.
Thank you. Next question comes from Sabri Azarika from MK Global. Please go ahead.
Yeah, good afternoon, sir. So two questions. First one is, so what is the current oil production in KG 98/2?
Currently, we are producing something of 12,000 barrels per day.
12,000 barrels.
Yeah. And
Okay.
Gas is around 1.75 million cubic meter per day.
Gas is around?
1.75.
1.7 MMSCMD is gas and 12,000 barrels per day is oil.
Right.
And you are selling it also, or is it, or you are like storing it right now, just oil 12,000 barrels per day?
Oil, we have got a tie-up, we are in the process of making a tie-up with MRPL for the first load of the tanker.
Okay. So, does it mean that, you have something like 450,000 barrels per day of oil, so this 12,000 will add into there, right? It will be reflected in Q4 numbers, whenever they come, right?
Q4 numbers will be reflecting this 12,000 barrels.
Okay, sir. And secondly, what was your 9 months cumulative 98/2 gas production?
98/2 cumulative?
Gas production from 9 months.
Okay, Sabri, we'll come back to you. If
Yeah,
you have something, you can go ahead with that.
Yeah, yes. Okay, I'll touch base with you personally, sir. So, second question is regarding your windfall tax. So now it's like largely established that the government has allowed you around $75 of net relation. But given the fact that we are almost like 1 year down the line and next year your cost and all will also go up. So have you gone to the ministry or to the government asking for an increase in this hurdle rate in order to take care of whatever cost escalation happens in the oil side? And I know in gas, I think from FY26 onwards, 25 cents is something which was given in the guidelines. But for oil, are you requesting the government to look into this, or have you got any indication, or do you expect that the windfall hurdle rate will be increased from 75 from FY25 onwards?
Yeah, just one sec.
See, as far as SAD is concerned, it's government policy. We have been pursuing with the government for reviewing this, but currently it will be difficult for us to say exactly what will happen as far as SAD is concerned. But yes, we have been pursuing it with the government. But you might have seen that our cost figures also that way, like the way you are apprehending, it's not that costs are going to escalate very high. The OPEX numbers have been more or less steady as far as ONGC is concerned. So we don't expect that the cost would be substantially higher that way. So really the price that we are currently getting is also a comfortable price for us.
Okay, so any guidance on the cost side can you give? Because if I look 9 months 23, so your total other expenditure was around 13,600 crore. So 9 months 24 has been like 16,000 crore. So it has actually increased. So FY25, do you expect it to be like similar, or is it like, I mean, you see it a normal increase, or can it increase higher given that rig rates and all are like higher?
Yeah, one major reason that you find that, the expenditure in totality has gone up compared to last year is because we started taking a hit on GST on royalty last year. A substantial amount has been booked into, 9,000 crores we took for pertaining to previous years and 3,000 crores of last year. So that now the expenditure is around, say, 2,300, 2,400 crores annually that regularly now we have decided to take hit. Though we have been pursuing with the government, and we are very hopeful that the 9th bench, has been constituted at the Supreme Court, and we are still hoping that we'll have a favorable decision on that. So in the past, we were just showing it as a deposit, and we were not taking a hit in the P&L, which we started in the annual accounts last year. Apart from that, if you see the expenditure that we have, the cost escalation is coming through mainly for development purpose only. Like, if we say for example, in the offshore, we have decided to spend money on water injection, which will result into, we are expecting that from the existing mature field, we'll have more production. So those kind of expenditure only. It is not like expenditure which are in the nature of, infrastructure expenditure. Yes, as you said, drilling cost is one major component in the cost, which in the current year it has gone up more, but we are expecting that the prices for the rigs also, we are expecting that based on the projections, it will cool down.
Okay, sir. And just one small question. So SAD is being imposed on 98/2 crude also?
Yeah.
Right now we are getting it reviewed. This applicability of SAD and other taxes, it is under review. Right now the preliminary review is that it may not be applicable, but it is not final. It is under review.
Okay, so right now the rough cut view is that SAD may not be imposed at all on the 98/2 crude. That is 12,000 barrels per day. Okay. Okay, so thank you so much and all the best. Yeah.
Thank you.
Thank you. I request the participants to restrict with one question in the initial round and join back the queue for more questions. Next question comes from Gagan Dixit from Elara Capital. Please go ahead.
Yeah. Thanks for taking my question, sir. Sir, there is a news that ONGC planning to drill a well in the Andaman Basin from May. So what I read in the earlier DGS reports that it has a potential of like under 80 million ton or 1 billion barrels something. So am I assuming this is something the similar resource that you are targeting from the exploratory well from that basin?
It's the exploratory well under the OLP bid round, what we have got the block there, and we are taking our first exploratory well in this calendar year. And the resource, we will be able to, resource estimation from this well, we will be able to communicate later on.
Okay, because I thought that might be you have some idea about based on your 2D, 3D surveys, so that's something minimum target that you are targeting. Okay.
So it's exploratory well, So let's hope and wait and watch that we get a good result from this well.
My second question is, sir, that there's also the news that this ONGC is in talks with restarting its production in the Libya that they exited 13 years back. So, any status of it, if you can just point it out, sir?
ONGC Videsh does not have any production asset in Libya. So we don't, have any option to produce from there. As of now,
Okay. That's from my end. Yeah, thanks.
Thank you. Next question comes from Vikas Jain from CLSA. Please go ahead.
Hi, sir. Thanks for taking my questions. Firstly, sir, your OpEx is very, very high for this particular month, even this particular 9-month, even after we adjust for your GST on royalty. It is for this particular quarter, it's at about, at this 9-month, it's 25% up YOY, which comes on top of a 11% increase that we saw in FY23, a full year. And this is even before fourth quarter, which typically has been a quarter where you typically have ended up booking large OpEx for the last 5-6 years. So what exactly is happening? Because my worry is that government, in most cases, whether it is our oil realization or gas realization, they are capped at a particular level. But if OpEx keeps rising and production anyways, we've been struggling to grow it, how will profits kind of improve if that is really the case? So any particular reason why one can imagine that this 25% increase in 9 months is a one-off? And secondly, fourth quarter, will it again see a jump, which typically it has seen in the last 4 or 5 years?
Yeah, just a second, Vikas ji.
Yeah, you were talking about the increase in OpEx over the 9 months period, right?
That's correct.
Basically, if you have seen that, in this quarter, Q3, by Q3, the OpEx increase is only about 105 crores. We are more or less on the same level that we had for the last year. As far as 9 months is concerned, the increase is mainly because, during the COVID period, we had the operations were down, and then we had some, damages happened, which happened in the also. So one-off expenditure in terms of repair and maintenance, almost 323 crores is on account of that. And then, as I said earlier, to another question, we are focusing more on water injection, which is, more like a development expenditure, though we are booking that in the OpEx. So that's around 224 crores on water injection we are spending on the Western Offshore. So these are, one-off expenditure which are contributing. It's not that, they are regular, expenditure. In addition to that, on VAT amnesty scheme also, we have decided to go ahead with one case, and where we are paying about 160 crores. Apart from that, some of the old blocks that we had, where we exploratory blocks, where there were certain claims with respect to LD and other things, which we mutually decided to go through a eminent committee. On the basis of the recommendation, we have decided to pay some amount. So most of the increase that has happened is, in the nature of one-off expenditure. They are not a regular, increase on the basis of the production numbers. They are not directly variable with the production numbers.
Sorry, so when you say like water injection, that would not be one-off, right? I mean, now you will account for it every quarter whenever that happens.
No, what I'm saying is that once we pick up a field and we decided to go. See, water injection is not something which we incur on the basis of the production every year. Certain fields where we feel that the need for water injection was there, we had been postponing it for some time in the past, and now in the current year, we have decided to go for it.
Okay. No, so the last part that you mentioned around some provisions that you've thought of accounting, that has all increased the OpEx number for this particular quarter. How much is that total number? I mean, is there provision or whatever you said that you have, or is that an ongoing thing that you have decided to charge every quarter from here on?
No, not in the nature of ongoing things which we decided. Earlier, we were having certain dispute with respect to completion of some of our exploratory schemes, which we could not, either for reasons beyond our control, things got delayed. So the applicability with respect to LD and other things were in dispute. So we decided to go for a dispute resolution mechanism, and we had constituted an internal committee of eminent experts who are mostly eminent people from this industry. Through them, we decided that, okay, let us close this. Similar to the VAT amnesty scheme, which you are aware. So that's also one-time solution to, mutually agreeable solution, which we decided to go for. So they are not in the nature of recurring expenditure. The numbers which I told is that with respect to this LD for 9 blocks was 136 crores, and the VAT amnesty scheme was around 180 crores, which we have booked in the current.
And sir, I mean, see, what I'm worried about is if you see a simple lifting cost has gone up for 9 months versus $10 is about $12 or so. Okay. And if we also look at our, the exploration write-offs, etc. And this is even before the fourth quarter. Fourth quarter, typically over the last 5 years has been, 5-6 years has been a quarter where there's been very big charges which typically come in both in terms of exploration write-off as well as operating expenditure. So is there any change that we may not see something like that in fourth quarter, because even on an ongoing basis, OPEX has been higher through this 9 months, or that, that's something, that this is the new OPEX number we should be working with?
Yeah, see, as I said, you talked about the lifting cost. In fact, precisely the water injection that we are doing is also forming part of the lifting cost. Whatever the water injection that we do in the reservoir, that is basically adding to my lifting cost. So again, that is one reason why the cost has increased. As far as the exploratory write-off is concerned, in this particular quarter, we have taken a hit of about, one well in Mahanadi, which was an expendable well. That is almost 500 crores for one well. So these are not the expenditure that we expect that will happen regularly. This kind of industry, such things do happen. One-off expenditure once in a while do come largely, but we don't expect that the dry wells that we are going to be charged in the last quarter that you are asking me, that we are not expecting it to be high.
Okay, and just one more thing, the new change in Mozambique in terms of the way the ownership has been structured. So this will now allow us to book reserves as well, because earlier, from what I remember, part of that, 10% was owned by the 10% where 6 was owned by you and 4 by Oil India. That was in the form of an investment. So reserves could not have been booked. So that will change now, right? I mean, we'll be able to book reserves. Is that correct?
Yes, correct.
Yeah.
Correct.
Okay. So that should, yeah. Okay.
16%.
Sure. Thank you so much.
Thank you. Next question comes from Somaya V. from Avendus Spark. Please go ahead.
Yeah, thanks for the opportunity, sir. Sir, in terms of the new projects that we have lined up, besides KG Basin, can you just give some color on next 3 years or so? What are we expecting in terms of incremental production from these projects, and what is the CapEx spend related to them?
Incremental production from KG 98/2 or the total project what we are planning in the next 3 years?
Outside of, KG 98, the incremental projects that are coming online next 2 to 3 years. So what is the production expected from them, and what is the CapEx that we need to spend for?
The total CapEx, as I earlier said, that it is in the ongoing project is valuing something around 60,000 crores, which will be materializing in the next 2 to 3 years. And they will be having a life cycle gain of around 80 million ton of oil and oil equivalent. And moving forward in the next 3 years, we will be expecting something around 5 million ton of oil and oil equivalent from these new projects, of which the major chunk will be coming from 98/2 to the tune of around 4 MMTOE, and around 1.5 MMTOE from Daman upside. Then we have got the CBM project in Jharia and Bokaro, which will be contributing around 0.5 MMTOE. We have got the S1 Vashishta, which will be again contributing around 0.5 MMTOE. And we have got a few other projects of development of contract areas under this DSF2 blocks are there. Then we have got Mumbai High Redevelopment Plan Phase 5, which is upcoming,
Daman upside.
So Daman upside I already told you. And there are various EOR projects which are upcoming in the onshore projects, which will be again adding up to something around 0.3 or 0.3 to 0.4 MMTOE. So these are the projects which we are looking forward to for completion in the next 3 years.
Got it, sir. So one question on the CapEx, this 30 to 35,000 crores of run rate that we are mentioning, can we just give some color on, you did mention that now in terms of new projects, this is a 60,000 crores spent probably over a 3-year time frame. So what is the level of maintenance, exploration and new project spend, if you can give a rough breakup in this 35,000 crores for the next 2-3 years?
So if you broadly see that whatever our capex outlay is there, our development projects contribute something around 60% of our total capex outlay in the development drilling as well as the capital projects what we are taking on.
Yeah. So to be specific, basically if you see, survey would be around 11%. Okay. And exploratory drilling would be somewhere in the range of 22%, and development drilling would be in the range of 25 to 27%. And the balance would be on infrastructure and other capital, which would be around 37%.
And sir, also this, any update on the OPaL equity infusion?
See, we have already drawn up a plan of infusing around 19,000 crores of capital. The proposal has got approval of our board, and we have already submitted to the government, but it is under active consideration at the government level.
And the capex number that we are saying, 35,000 crores, is a standalone level. It does not include any equity infusion.
That includes a minimum equity, not the OPaL what sir was talking about.
Understood, sir. Thank you.
Thank you. Next question comes from Manish Oswal from Nirmal Bang. Please go ahead. I repeat, question comes from Manish Oswal from Nirmal Bang. Please go ahead. There is no response, sir. Thank you, sir. There are no further questions. Now I hand over the floor to Mr. K.C. Ramesh, CFO, for closing comments.
Yeah, thank you. Thank you all for joining this call today. It has been a pleasure for us to take all your questions. As was said in the initial remark by our Director of Finance, we are expecting that going forward, in this particular quarter itself with the KG 98/2 commencing production, the production numbers that we have for last quarter of the last year, we will be able to maintain in the last quarter of current year, though for the first 3 quarters, it has, it's slightly on the lower side. But we are hoping that for, better outlook, and we are very confident about the future that whatever initiative that we are taking in terms of further foraying into other areas apart from the conventional oil industry, they would be paying us good dividends. The investments have been well, planned on a well thought out basis. So with this, the price outlook for gas is also pretty, good that we have already got based on the grid parity committee. We are expecting that the incremental production which is coming through gas would be fetching us almost $9 to $10 per MMBTU. So gas would be adding substantially to our top line and bottom line as well. And with our persistent, we will be trying to keep taking up with the government with respect to the SAED applicability, and hopefully if we can get something positive on that as well. On the oil front also we will be doing comfortably well. So, with controlling the cost is one area that we have been focusing now, and we hope that we'll be able to identify certain areas where we can focus and reduce the cost as well. So both on the cost and revenue front, we hope that we can substantially add to the bottom line. So with that, we hope that, in future, from 98/2 adding and the Daman upside, which Mr. Pavan Agarwal was saying earlier, that's also going to come. So the production numbers, as well as the new initiatives that we are taking, that will pay us dividends, and We keep, continue to pay good dividends, which we have been doing in the past as well, and the current year we have already given an indication of where we are in terms of paying dividends. So with all this, the outlook looks quite good for us, and we hope you all will be there with us in this journey. Thank you. Thank you all. Thank you so much.
Thank you, sir. Ladies and gentlemen, this concludes your conference for today. Thank you for your participation and for using Doorsabha's conference call service. You may disconnect your lines now. Thank you and have a good day.